I'm Doris. I'm here to share with you about my stock account and the market updates. European financial giant Rothschild family reduces Nvidia, saying the valuation is too high. Weak oil prices and OPEC Plus is considering further production cuts. As Nvidia's market value exceeds $1 trillion, the Central European financial giant, the Rothschild family, has begun to reduce its position on the AI computing chip giant. On June 3rd, market insider Benjamin Melman, global chief investment officer of Edmund Rothschild, has overpowered Nvidia since the end of 2020, but has taken some profits and is far smaller. Edmond Rothschild, headquartered in Geneva, Switzerland, is currently managing 79 billion Swiss francs of assets owned by the Rothschild, more than 200 years old family. The Edmond Rothschild has reportedly been increasing its stake in Nvidia shares since at least the end of 2020, and Nvidia stocks has recently benefited from the artificial intelligence concept, and the company undoubtedly makes some profit. Nvidia's share price has risen by an eye-opening 172% this year amid the AI concept boom, up about 30% last week alone, while Microsoft and Google, parent Alphabet respectively, Nvidia has been the biggest winner in the AI boom. Even Nvidia's most committed bulls certainly cannot predict a market cap surge to $1 trillion. Investors have taken this and tried to ride the waves, pouring a record of $8.5 billion into the AI technology fund last week alone. But how much is too high? Nvidia holders seem to think it's time to hit the brakes and it's time to settle. Edmond de Rothschild global CIO Benjamin Melman said in an interview with Bloomberg, "We'll add our positions to AI technology because valuations are too high. We're increasingly uncertain and will be more cautious if we continue to rise." Recently, like Edmond de Rothschild chose to high cash, there is a self-called value investor, contemporary famous investment valuation expert, Asworth Demodalan. He said that on May 30th, Nvidia was still in my portfolio until this morning and finally took it off my portfolio because I couldn't afford the rise and adding $300 billion in the market value in a week, which is challenging the absolute limit of a sustainable value. As Nvidia spokesman declined to comment on Edmond Rothschild's reduction. For now, most Wall Street analysts think Nvidia has room to rise further. Most of the 49 analysts surveyed by financial data provider FactSet, 41 gave buy rating on Nvidia, up about a third from 30 in October. Analysts' average 12 months price target in Nvidia is just below $432, meaning the stock is up 110% from its latest close. Nvidia's share hit record highs for the 3 consecutive days. Meanwhile, Nvidia's Nasdaq 100 rose 7.6% in May, the highest since 2005, driven by the AI boom and expectations that the Fed will pause in raising interest rates. In fact, Wall Street has recently acknowledged that the AI concept has been overvalued. By the end of last month, Cassie Wood, the Wall Street investor and head of ARK Investment, really labeled Nvidia as too expensive enough. At the time, she said, "The world's most valuable chip maker has already been overpriced. Now Nvidia stock is up 80-fold, and investors seem to think it's the only investment in AI, but that's not." In a recent note, Bank of America strategist Michael Harnett noted that the tech stocks and AI concepts are bubbling, suggesting investors can sell US stocks. He admitted that the current concept of AI is in a bubble of infancy, and the Fed's rate hike may not over. In the past, bubbles were usually formed by the loose monetary policy and ended with raising interest rates. The situation is a good reminder that while AI could eventually become very powerful in the long run, asset prices could still fall sharply from the current levels. Even the strongest and best performing companies risk being overvalued when investors decide to sell for cash. It's Nvidia and its AI peers to convince the market. OPEC Plus will consult on June 4th local time to review the group's future production policies. Analysts have expected OPEC Plus to maintain its current policy, but recent signs suggest that adherence may not adequately stabilize the oil market. In April, several OPEC Plus members agreed to voluntarily cut production by more than 1 million barrels a day, a surprise move that briefly supported oil prices but failed to deliver a lasting market recovery. AFP reported, the Russian-Ukrainian conflict has overturned the global economy, and the oil producers are struggling to cope with the problems of falling prices and volatile market volatility. Most of the delegations refused to comment on the possible policy decisions when they arrived in the Austrian capital on Wednesday. An unnamed source told AFP that another 700,000 million to 1 million is one of the barrels per day to 1 million barrels per day is one of the options being discussed at the meeting, stressing that nothing is unchanged. Analysts are divided on whether Saudi Arabia and Russia, the group's heavyweight members, will support maintaining their current output policies or cutting production further. According to the Wall Street Journal, as Russia's priorities shift over war and Western sanctions, some analysts say that OPEC Plus no longer exists, and that Saudi Arabia, the world's second-largest oil producer after the U.S., is basically doing its own thing. Jeff Kahn, a political science professor at the Brown University, said, "We're back to the old world dominated by OPEC, where most important decisions are made entirely in Rhodes, not in Vienna." That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.